Hi, a very good afternoon to all of you. I hope everyone are doing well. Let me first start by wishing those of you celebrating Chinese New Year in the year of Ox and auspicious year that brings you blessing of good health, happiness, and prosperity. My name is Joanne, the Manager of Learning Support at ACCA, and with me as well, my wonderful colleague Ryan from ACCA as well. Now, all of you know that next week, Thursday, is your SBR exam, and you only have 9 days from now to exam day. So how much can you study or do at this point of time? Now let ACCA and our expert tutor, Tom Clendon, to guide and help you with your final preparation for the paper. Now I know you guys can do it, so you just need that one final push to pass. All right. Now before I hand over to Tom, I'd like to give you a quick cover on your housekeeping item. Now, if you have any questions during the session, please use the Zoom control panel chat box at the bottom of your screen and select to send to our panelists and attendees so that others could actually see your comments as well. Now, we will aim to answer your question during the session. So without any further ado, I will now pass the session to Tom. Tom, over to you. Thank you.
Thank you very much, Joanne. Thank you very much, Ryan. And welcome everybody wherever you are in the world. I'm here in London, in the UK, and it's very early in the morning for me. So I'm bright and breezy, and I hope you've had a good day, and I hope we're going to have a good session. So what are we aiming to do today in these 3 hours or so that we've got together? Well, one thing I want to have is a bit of backwards and forwards with you, a little bit of interaction. So I'm going to be asking you questions, mainly through polls. So I'd like you to be able to respond to those. I'm going to try and get you to do a little bit of work. There is a session at the end, obviously, for questions and answers. And so that can be on anything. But as we go through, I would occasionally pause just to make sure there aren't any particular questions on what I have just said in terms of the presentation. So I hope you're all well. I hope you're all reasonably well prepared for Thursday week. And you can see there our agenda. We're going to look a little bit at deferred tax, a little bit at group accounts, and we're going to have a bit of a tease, have a little bit of a look at a current issue, if you like, in terms of crowdfunding. So those of you who don't know me, oh, look, I'm wearing the same shirt. Those of you who don't know me, my name is Tom Clendon. I am an ACCA member. So I did these exams many years ago, obviously before there was the internet and before there was all these international financial reporting standards. But anyway, that's another story. What I'm saying is I was combining studying and working as well. So I can well remember the pressures that I was under and that you also must be under as well. I qualified with KPMG, but I have spent most of my career working in ACCA, working in education, teaching ACCA students, and that was spent through Kaplan. I did spend 3 years recently living in Singapore and teaching across the Southeast Asia region, a period of my career that I have tremendously fond memories of. And of course now, sadly, I have to do it online. So it means that when I finish this presentation, I can't go to a hawker stall or sit on a stool and have some fur or whatever. Since I've come back to the UK, I am also working for ACCA in various capacities. I'm not an employee. I am a lecturer. I have my own students and run my own online SBR courses, but I engage with ACCA, or ACCA engage with me to support them in various ways. So that's me. That's who I am. One thing I would suggest is that you mix up your revision. So of course you're doing past exam questions. Of course you're learning some definitions. Of course you're reading articles. But maybe it would be good if you listen to a podcast. So I have a podcast, and that podcast is dedicated to SBR. So a couple of days ago, I recorded a 20-minute podcast which explored the issues of hedging, how you account for cash flow hedges, how you account for fair value, how you account for derivatives. Anyway, so, you know, if you're going out for a jog, if you're a bit of an insomniac and you still want to combine your SBR studies, find my podcast. It's on Spotify, it's on Google Podcasts, it's on Apple. All you would have to do is key in, even if you just keyed into Google, Clendon, my name, yeah, ACCA Clendon podcast, you would find it. I have an unusual name, all right? Also, you can connect with me on LinkedIn if you want to. I post regularly about SBR, and you can see a back catalogue of some of my articles and posts that would be of use to you. So I've introduced myself, and what I would really like to do is to get to know you a little bit and for you to introduce yourself to me. So you can see displayed there a question which will give me a feel for the audience. You know, back in the day, I'd ask you to put your hands up. You know, that is obviously not available at the moment. So I'm seeing the answers come in. Thank you very much. It's a fairly simple question, isn't it? You know the answer to this. And I'm going to give you 5 more seconds to answer the question if you haven't answered it. 5, 4, 3, 2, 1. And of course, it's one of those polls where, you know, there's no right answer or there's no wrong answer as such. And I can see that half of you are coming to this exam as virgins. Half of you are coming to this exam for the first time. And it's a tough exam because I can see that the other half of you have been here before. So some of you are a bit battle hardened, maybe a little bit cynical, but you know the fight that's ahead. And you've got to do something different this time. Yeah, you've got to do something different this time to get over the line. So there we are. It is what it is. That's my first little poll here in getting to know you. And there's a second poll that I would also like to look at. And that second poll is asking you how you're sitting the paper. I'm talking to people from a different range of countries. Yeah, some of you in Malaysia, some of you in Hong Kong, some of you are, yeah, wherever you are. And I'm curious to know at this moment in time whether you are doing the exam in a traditional paper-based way or whether you're doing the exam as CBE. And I can see an overwhelming result here that basically everybody is doing the exam as paper-based. All right. So we don't have any. So I'm not going to make any reference to computer-based exams, except this: computer-based exams are coming. They are coming to your country very soon, and when they do, it's fantastic. And when they do, it requires you to take on a little bit of extra knowledge. And I'll come back and talk to you about that, yeah, nearer the time. Joanne and Ryan will make sure that I get the opportunity to support you on that additional journey. So there we are. That's our introductions. And I want to introduce the exam paper very quickly. Yeah, very quickly. Because it's revision. You know that question number 1 is groups. And you know that when you do question number 1, it's words. Yes, there are some numbers to support, but most of the marks are for words. You're explaining the impairment loss. You're explaining the exchange difference. You're explaining the calculation of goodwill. And then you do the numbers. Always do the explanation first and then get the numbers to support it. Most of the marks are for the words. You will never ever be asked to physically prepare a whole set of group accounts. Question 2 is ethics. Listen to me. Don't write out the 5 pillars. You are not going to be asked a straight question on ethics. Ethics is always tested in the context. So there's an accounting treatment that has been done incorrectly, and you're explaining the accounting aspect and what should have been done. Maybe it's a related party that wasn't disclosed. Maybe it's a lease that has been dealt with in the old way. Now, the ethical angles are separate and reflective and in context. Anytime you see a mistake, anytime in question 2, if the person in the question has done something technically wrong, call it out. Lack of competence. A mistake has been made, full stop. Yeah, ethical behavior requires competence, full stop. Mistakes are therefore unethical, full stop. Link the scenario to the ethical principle. And if you link the scenario to the ethical principle, not only will you get the marks, but you'll get the professional marks. That's one of the things we're looking for in awarding professional marks. Mistakes are unethical because of lack of competence. But very often, mistakes are plural and a pattern, and there may be a suggestion that those mistakes amount to something that is deliberate and a pattern. And that implies creative accounting. That implies a lack of integrity. So if you in any way, shape or form feel that the errors are cynical attempts to boost profit, to hide dodgy related party transactions, to minimize the gearing, use your judgment and say, hang on, yes, it's a mistake, and mistakes are unethical if they're innocent mistakes. But we have a pattern here, especially if there's a reference in the question to needing to hit a profit target. Yeah, unethical behavior is a motivation. And finally, even if the question doesn't ask for it, throw in a sentence of action. If you go to a doctor for a diagnosis, the doctor is going to tell you what's wrong with you, and then he's going to prescribe you a drug, an operation, tell you to lose weight, whatever it is. And therefore, you're that doctor, you're that professional, you're that analyst. And so in question 2, always please end your answer by saying, tell someone, independent, non-exec, auditor, tell someone, consult with someone, yeah, maybe even take legal advice. And as a last resort, think about resigning, because you don't want to be in a unethical situation forever and doing nothing about it. I like question 2. Some of you like question 2 as well. Yeah, it's a good question. Yeah, one you can do well on. Question 3 and 4. Time management can be an issue sometimes if you do the questions in the traditional order. You don't have to. You do them in any order you want to. Just make it very, very clear the order in which you're doing your questions. Standards, applied, we're going to see that. Yeah, current issues, we're going to see that. All right, so you know the paper, I know the paper. Yeah, it is about applying your knowledge. It is not just about rote learning. Numbers are illustrative. Just have a read of that for 2 seconds. passing this exam requires you to have some knowledge, but passing this exam also requires you to use that knowledge in the right way in the exam. You're doing the right thing by attending today, and I thank you. So you are preparing to pass. Yeah? Because if you fail to prepare, you are preparing to fail, but you are attending. You are good students. When you are in the exam, read the question, because only when you've read the question can you begin to answer it. You've got to read the requirement. Now you've got to think like a marker. You've got to try and get one mark at a time. And you know, I want your script to contain lots of white space. I want your script to have a sentence or two, paragraph, leave a line, so that you're challenging your marker. If you've got a question which is, say, worth 5 marks, maybe it starts with a definition. Yeah, but then maybe you explain and discuss a fact within the question, explain and discuss a fact within the scenario. You evaluate what's going on, and then you arrive at a conclusion. And each of those start, middle, 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 end is a separate mini paragraph, 1 sentence, 2 sentences. Application, application, application. Yeah. My students did an exam at the weekend. Time pressured exam. Yeah, a mock exam that I set them to do. And the feedback already is so many of them ran out of time. Half of you have done this paper before and half of you haven't. Let me talk to those people who haven't done it before. Oh my God, it's time pressured. So you've got to have that discipline. And if you can do a mock exam to time between now and Thursday and get that marked and get that reviewed by a tutor, that would be fantastic preparation. The reason you're reading the question is so that you can answer it. Yeah, you've got to have a skim read of that question, and you've got to settle down and you've got to answer the question. And I've got some questions for you in a moment. I've got some questions for you in a moment to be thinking about. But unless you read the question, unless you understand the question, you can't begin to answer it. And as I have said, and as I keep on saying, most of the marks are for explanations, discussions, not repetition of definitions and not numbers. It's a strategic professional paper. We've used polls. Now we're going to use the chat box. I can see the chat box. And I want there to be a flurry of information in the chat box. I don't want the accounting standard number. I want one word. Why would you be told an asset was damaged? What is the trigger? What is that? Thank you, Mohammed. Yeah. What is that? Yeah. Thank you, Ifa. Thank you, Priya. Thank you, Jocelyn. Yeah. Thank you, Karen. Thank you, Sabina. Oh, they're coming through too quickly. Fantastic. You know, so that's a trigger that you start getting involved in impairment. Thank you, my keyboard warriors. You are quick off the mark. We're moving on, Jazz. Yeah, we're moving on. What's the accounting issue if management have decided to sell the asset? Thank you. Held for sale. Asset held for sale. Thank you, Jenny. Yeah, thank you, Randa. Thank you, Neural. Thank you, Nicholas. Yeah, absolutely. So, but actually deciding to sell the asset is not enough. You've got to have a commitment. You've got to have an active plan. It's got to be available for a sale immediately in its own condition. And it can't be damaged. And it's got to be sold at a reasonable price. And then it's got to be highly probable that the sale is going to take place. So the question will contain some clues. And if they've got the price too high or the asset is damaged, it's not going to be held for sale. If it is held for sale, current asset. If it is held for sale, no depreciation. You know this. Green credentials, oil rig. What's the accounting issue there? I mean, yes, there's something in integrated reporting. Saeed says provision. Yuan says, Saranjet says provision. Yeah, oh, I like that. PPE. Yeah, PPE comes in as well. Yeah, I like that. Dismantlement. Yeah, yeah. Can't see government grant there, Jenny. Can't see that's an issue. But dismantling costs, yeah. So if you've got green credentials, you're raising a valid expectation that you're that you're a good company and that you will decommission an oil rig that you put up in the sea. And therefore, if you're going to decommission that oil rig, that's going to meet the definition of a liability under ISA 37. So I'm loving this. Yeah, decommissioning provision. Yeah, environmental provision. I can see what's happening here. Yeah, fantastic, Fadley. Absolutely. So you would capitalize that because it is PPE. You would measure that at present value. I'm talking fairly quickly. I'm jumping around because the exam's next week. Hopefully, most of what I'm saying, you know, because it's revision. I mean, that's the nature of the beast, isn't it? All right. So I'm validating, I'm helping you get your wires, your brain connected in different ways. The company has guaranteed a loan taken out by the director. Ooh. Mohammed, thank you very much. Yes, Lo. Yes, Sabrina. Absolutely. It is a related party transaction. You have to live on the front foot. You have to be aggressive. You have to say that directors are always related parties. So any transaction. Now, I know no money's changed hands. It's just a guarantee. No money has changed hands. So there's no debit or credit. So you would need to disclose this in the notes to the accounts, that the company has given a guarantee. There's more to it than that, though. There's more to it than that. Can I say provisions? Can I say ISA 37? Because you would have to make an analysis as to whether it was probable or possible that the director was going to default and the company therefore would be called to honor the guarantee. I am almost certain that it's only going to be possible. In fact, it might be a remote possibility. So yes, contingent liability is something that you might consider disclosing. But I still haven't finished. What other accounting standard is applicable when you enter into a guarantee? Related party transactions, if it's with a related party. Provisions, contingent liability, ISA 37. Oh, thank you. Thank you. Not impairment, but IFRS 9. It's a financial instrument. It's a financial instrument. All right. It's a financial instrument. It's creating an asset for one party. It's great for the director, but it's creating a financial liability for the company. And financial instruments are not recognized. So ISA 37 is all or nothing. ISA 37, if it's only possible, if the loan is 100 million and there's a 5% chance of default, there's a 5% chance the 100 million will have to be paid out by the company. The company under ISA 37 says nil. company says it's only possible under ISA 37, under provisions, contingent liability, no liability recognized. Under IFRS 9, initial recognition is different. Initial recognition is at fair value. And if it's at fair value, you can work out an expected value that a 5% chance to pay out 100 million is a liability of 5. So 3 different accounting standards being applied to one scenario. Yeah, I'm moving on. 3 different accounting standards are related parties, provisions, financial instruments. Look at the number of marks available. If this is marked for 1 mark or 2 marks, I suppose all you need to do is talk about the related parties. But look, if something's marked for 5 marks or 6 marks, you've got to say to yourself, I've done the obvious. I've said something for a mark or 2. What else might I be thinking about? What else might I be thinking about? The company has obtained a loan from a local government. The company has obtained an interest-free loan from the local government. Yeah, it's a government grant, absolutely. Yeah, there's a benefit from receiving its financial support to receive the government grant. And thank you, those of you who have changed your setting to show that your answers are going to all attendees. Previously, a lot of them were just going to panelists. So I was seeing them, but no one else was seeing them. And I can see a lot of validation that you're all into government grants. And what else are you into? If you've received a loan, a soft loan, what's the other accounting issue that you're going to have to consider? Yeah, you've borrowed money, so you have a liability. If you've borrowed money and have a liability, that is a financial liability. That is a financial instrument, absolutely. So it's IFRS 9. So it's initial recognition at fair value. It's amortized cost. So if it's 100 million, if it's 100, let's just say 100. If it's 100 and it's an interest-free loan for 2 years, you will debit cash 100 because you've got the money, but you won't recognize a liability of 100 because under IFRS 9, the liability is measured at fair value, and the fair value of paying back 100 million in 2 years' time with no interest is the present value of the future cash flow, level 3. So if interest rates are, I don't know, 10%, you might have a liability there of 83. So you've debited cash by 100, but you're recognizing a liability of 83 because it's the present value of the future cash flow, because it's payable in the future. And that's why you've got a 17. The 17 is your government grant. The 17 is the amount you're better off by, the government grant. And if it's a revenue grant, you take it to P&L. And if it's to do with fixed assets, capital grant, yeah, it's deferred income and spread. And then the 83 is amortized cost. The liability is amortized cost because you would then add the finance cost 10%, add the finance cost 10%, but no money's being paid out. The company has obtained an interest-free loan from the local government. Every word is crucial. Local government, it's a grant. Interest-free, yeah, that's the benefit, isn't it? They're giving us financial support through waiving the interest. That's to our advantage. Measure the liability at present value. Fantastic. And that would be, 3, 4, 5 marks, especially if a couple of numbers were thrown in. Question 2. Why are you told? Why could you be told? Yeah. If you're told someone is an ACCA member, I have expectations. If someone is an ACCA member, I'm going to judge them a bit more harshly because they should be competent. They should know their ethical principles. Yeah, they're bound by the ACCA Code of Ethics. Oh, beautiful words there. Thank you. Thank you, Nicholas. Thank you, Eugenie. Thank you. And correct, Fadley, you want them to behave in a professional manner. So, you know, if you're told that someone is an ACCA, and if I'm really, really cynical, in the culture of the exam, if somebody has proposed an accounting treatment in the exam, it's probably going to be wrong. Because it's very rare that an exam answer is the accounting treatment proposed is perfectly correct. There are no ethical issues involved. It's much more likely that the person who has proposed the accounting treatment in some way, shape, or form has got it wrong. And that then engages you to be proactive as to what the right treatment is. It then engages you to come up with an ethical angle of criticism, whether that's to do with competence or whether that's to do with integrity. Absolutely. We've got to be skeptical. We've got to have an inquiring mind. We've got to have an open mind. Yeah, brilliant. Last one. Last one. If you are skeptical and you are told in the question that the financial instrument, these redeemable shares, you know, if you're told there are redeemable shares or fixed term shares that have been classified as equity, what does your cynicism tell you? Oh, substance over form, faithful representation. Thank you very much. Yeah, not quite so sure about the compound instrument business. You know, but realistically, again, it's this business of being skeptical that you will find yourself disagreeing with the question. And equity is always desirable. Well, virtually always desirable, because classifying something as equity means there's no finance cost. If you raise money, debit cash. If you issue a financial instrument, debit cash, money comes in. Fundamentally, you either are recognizing equity, no obligation to pay the money back. Yeah, ownership interest, or you're recognizing liabilities because you've got an obligation to pay the money back and you've got a finance cost. So it's equity versus liability. It's ISA 32. And equity is attractive because it lowers the gearing, because it doesn't create a finance cost. Debt is ugly. Debt increases the gearing and debt reduces the profit. So if you're dealing with a nasty, cynical, creative accountant, they tend to want to show something as equity because it looks better, because it improves the accounts, because it can trigger their bonus, because they're keeping within debt covenants, they're meeting profit targets. So just be aware of these kind of tricks that have been played in the past in case they come up again. But it gives you that awareness. Why are you being told certain pieces of information? Because normally every word has some inference and implication in answering the question. Finally, last one. This is something you'll see. And if you're asked to comment on something from a shareholder's perspective, think about profit, think about the future. Yeah, think about dividends, think about the value of the business. Our shareholders are our primary users. All right? Absolutely. So, I've said this before, I'm going to say it again. When you are answering questions, you must think 1 mark at a time. Tailor the length of your answer to the number of marks available. I pretend the 15 minutes don't exist. I pretend the exam is 3 hours long. Yeah, and therefore I work on 180 minutes. I work on a ratio of 1.8. So if it's a 10-mark question, it's 18 minutes. If it's a 5-mark question, it's 9 minutes. And you are, with a 5-mark question, you're looking to make 5 points. There's no negative marking. You know this. Yeah. Plan your answer. We've talked about this. Definition, discuss, conclusion. Yeah. Identify the issue, soften that definition, discuss, take the facts in. All right. Take the facts in. Yeah. And the best way, of course, the limiting factor in the exam for many of you will be time management. How can you improve your time management between now and the exam? By doing questions to time, by getting quicker, by practicing questions. That's how you improve your time management. You also improve your knowledge when you review the answers. But for many of us, we run out of time potentially in the exam, and that's the issue. So doing exams to time, I've said it more than once, all right, because it's appropriate. You have to be brutal and move on. If it's a 5-mark question, sometimes it's very difficult to get the 5th mark. But if the next question is another 5-mark question, it's quite easy sometimes to get the 1st or 2nd mark in that 2nd question. So instead of squeezing an orange, instead of squeezing out the last juice of a question, you can say, I think I've got 3 out of 5 here. I'm moving on. That's okay. And I'm going to get a fresh orange and I'm going to have a fresh squeeze. Because if you want to maximize the amount of juice coming out, you've got to squeeze and try every orange rather than just really work 2 or 3 hard. You're missing out. Start the next question. Always start the next question. You can leave space. You've got that paper. Leave space. It's not a problem. Leave space. Come back to it later if you've got time. But must move on. Like I must move on in terms of time management. Yeah. Have I said that before? Do exam questions to time. That's how you improve your time management. That's how you maximize your chances of passing. Right, 1 minute. Don't go away. But you just got 1 minute to go. Don't go away. 1 minute. I'm just like, I'm having a glass of water. I'm not having a cup of coffee. I'm just having a glass of water. Right, okay, that's 1 minute nearly up. I want to get on with some sort of substantive stuff. We've been sort of gently talking about exam technique and introductions and all that kind of stuff. I'd like now to tease you with some technical information around group accounts. All right. In the beginning, for there to be a business combination, 3 things have to occur. There has to be an acquirer. So you have to identify who is the top dog, normally the parent. You have to establish that that top dog, that acquirer, has control. And you have to establish that it's a business that is being taken over, that there are inputs and activities. And if all three of those things occur, IFRS 3 tells us that's a business combination. And I want to focus on control. Control is a principle, not a number. It's a principle. It is normally evidenced by having a majority of the shares. But that is not the definition of control, nor is it the definition of a sub. Control is only there when you have P, P-E-A. Control is only there when you have the power over the investee in order to direct the operating and financial activities. So you can tell the subsidiary what to do. You've also got to have exposure to variable returns. So, you know, if you own shares in the company and the company does well, the share price goes up, you potentially receive a dividend. So owning shares in the company gives you exposure, and you've got to have the ability to use the power. There can't be a shareholders agreement that somehow prevents you using that power. And I want to test your knowledge in the application of this. Please, can you read alpha and water? Please, can you read alpha and water? We've purchased water. How is that going to be accounted for in the group accounts? I've got a poll coming up. So think about it. Don't use the chat box. Don't use the chat box. I've got a poll coming up. We've bought 40% of the shares, 40% of the voting rights. There are 12 other investors. There's a shareholder agreement. So let's think about, what this poll should be. Have you come to an analysis as to your conclusion? What do you think the relationship should be between alpha and water? We've bought 40% of the shares, but there are 12 other shareholders, each owning 5%. And I can see that a third of you have already voted. So I am just going to give you a little bit longer. The definition of a sub is a principle. So do we control water or do we influence water? I mean, I can see that significant influence is assumed at 40%, but it's not guaranteed. Now let's have a look at the answer. The polling has come in, and the majority of you, thank you, the majority of you have said it's a sub, and you are correct. You are absolutely correct that it is a sub, and I just need to convince you. Yeah, I need to convince you why it is a sub. All right. And it's a sub. And in the exam, if you've got 4 marks for this, you would need to write 4 things. And maybe the first thing you would write is, at 40%, it's presumed to be an associate, and therefore we would use equity accounting. Now, writing that out is a mark. Full stop, leave a space, new paragraph. But then you notice that there are lots of small other shareholders. Then you notice that Alpha has the ability to appoint the directors, and basically they can't be removed. So you would say, well, it may be a sub because Alpha has the power to appoint the directors, has the exposure to the variable returns through the equity shareholding, and you begin to arrive at your conclusion that in substance, in faithful representation, Alpha is in control and can't be removed. Because even if all 12 shareholders gang against Alpha, they can't change the agreement that allows Alpha to appoint. So it's a sub. It should be consolidated. There's a 60% NCI. Oh my God. Well done, those of you who came to the right conclusion. But just because you come to the right conclusion doesn't mean to say you're going to get 4 out of 4. Because you've got to talk about the associate, you've got to talk about the control, you've got to make the application, discuss the fact that they've got the power through the size and the disposition of the other shareholders, and then come to the conclusion. It is technically possible to still earn 2 out of 4 if you come up with a wrong answer. Even those of you who said it's an associate could still gain marks if you have discussed what an associate is, discuss what a subsidiary is, and then just kind of, gone off the boil in your analysis. So don't beat yourself up. It's not FR, it's not multiple choice, really. Let's have a look at alpha and gamma. Let's have a look at a second example. Again, there's another poll coming up, but again, let me give you an opportunity to read the question. Alpha has also acquired 40%. Now, the other 60% are held by a wide variety of individuals. Nobody owns more than half of 1%. Half of 1%. So there's 120 other shareholders at least. Nobody makes decisions with each other. Nobody consults with each other. There's 120 other shareholders in totally different countries. Since we have bought the investment, I am Alpha, we have actively participated in establishing what Gamma does. I want you to think about this one. Last time, half of you got it right, just over, and some of you fell by the wayside. We've got a new poll coming up, Alpha and Gamma. On a new poll coming up, Alpha and Gamma. And I've just got to work out how to share that poll. Wait for a second. Alpha and Gamma. And I think you know what you're going to be asked. And I think you know what the answer is. We own 40%. But the other 60% are held by lots of strangers. Those strangers are unconnected. We have established the financial and operating activities of the company. The definition of a sub is not a number. The definition of a sub is not a number. The definition of a sub is a principle of control. So does Alpha control Gamma? Does it tell it what to do? Yes. Does it have exposure to variable returns? Yes. And there's nothing in its way to stop it happening. Look at the truth. We don't have a majority, but we do have control. I am so pleased because we now have a greater situation. We now have a greater situation where 62% of you, are now on board with the idea. That actually what's going on here is that we have a sub. This is a subsidiary situation. Even though it's 40%, there's no joint venture, there's no agreement that requires us to consult the other parties at all. So it's not a joint venture. So I've converted some of you. I would have liked to have converted more of you, but at least I've converted some of you to appreciating and understanding that that a subsidiary is based on control. Control is not a number, but control is a principle. All right. And that's what you would have to explain. You've got to look at the truth and the substance of the arrangement. That's why you're told the other shareholders are small and unconnected. So we've looked at that. We've looked at that. You've seen, that 62% of you were on track. Well done. That's a bigger percentage than before. We're moving forward. We're making progress. No poll for a minute or two. Sit back and relax. Questions just been asked. 4-mark question. Should we still address control under IFRS 10? Yes. I mean, give that definition, the power, the exposure, the ability to use, but try and integrate it into the case study straight away. So rather than just give a rote learn dump definition, try and take the definition and use words within the question. The reason that you have power is because you've got the appoint to direct. So sit back, listen. What I'm about to tell you, you know already, at least I hope you do. You shouldn't be learning anything for the next couple of minutes, but just sit back and enjoy. When you buy a new business and you've got control, you start acquisition accounting. So when you've got a new sub that comes on board, when you buy a sub, you calculate goodwill for the first time. Goodwill comes into the group accounts. NCI comes into the group accounts. And assets and liabilities of the subsidiary are consolidated in full. This is true. You did this at FR. Now, when you lose control, when you go from 60% to nothing, or 60% to 5%, or even 60% to 40%, when you lose control, you stop acquisition accounting. You no longer consolidate. In the income statement, you bring in the results up to the date of disposal, but in the balance sheet, you are removing the goodwill. You are removing the NCI, and you are removing the assets and liabilities. There's a yin and there's a yang. When you acquire control, turn on. When you acquire control, it's exciting, it's a birth, it's a new member of the family. On disposal, it's again a radical change to the group structure. On disposal, you've got a lack, you're de-recognizing, you're removing. Now, on disposal, you also have a profit or loss arising on disposal. And you'll remember that it involves moving away the goodwill, moving away the NCI, moving away the net assets. You know that. Okay, nice and gentle. I want to change gear. I want you to think about transactions where control doesn't change. So if you own 90% and then you buy 5, the purchase of the 5% is a bit silly. It's not radical. It's not creating a major change in the group structure. All that you're doing is effectively reducing the NCI. You're buying out the NCI. And in buying out the NCI goes down. Yeah, and it's a transaction between the parent and the NCI. You've paid money out. I am the parent, we've paid money out. It's very, very similar when we sell. So you could have 90% and you sell 5%, that would still be a sub. It's very similar when you have 80% and you sell 20% and you still have a sub. These 4 scenarios are all control to control scenarios, because all 4 scenarios, it was a sub and it's still a sub. No one's born, no one's died. You've just had another birthday. I mean, in this second situation, you're making a sale. In this second situation, you're selling a slice of the business. You're selling 5% of the business. You're selling 20% of the business. This is an area that we're going to do a series of polls on. This is an area that I want you to be comfortable with. I'm setting the scene. And the theory is there's no change to the goodwill, because you haven't made an acquisition and you haven't made a disposal. So goodwill remains the same. This is a transaction within the group. It's between the parent, it's between shareholders, between owners of the group. It's within the group equity. So under the single entity concept, there cannot be a profit or a loss. There just can't be. There's nothing in other comprehensive income. There's nothing in other comprehensive income. There's nothing in other comprehensive income. Because it's a transaction within the group, between the parent and the NCI, within group equity. If this comes up in the exam, you're writing this, the numbers will be different each time, but the theory is always going to be the same, because the theory is, in these in the situations we've looked at, there is no change to goodwill. It is a transaction between the parent and the NCI. That's why there is no profit or loss in the group accounts, but there is a difference. And the difference goes directly to equity. 3 marks? Explaining what's going on? Be lovely if it came up. I think it would be lovely if it came up again. First one's always going to be tricky. Second one's going to be a bit easier, but the first one's going to be a bit tricky. I have an 80% sub. Then you got pen and paper here, pen and paper, go and get pen and paper, or maybe you do it in your head, but pen and paper is probably better. Can you work out the difference taken to equity? Can you do that? Can you work out the difference taken to equity? It's an 80% sub. The assets are 200, the NCI is 30, the goodwill is 10, and we are buying 10% more. So we go from 80% to 90%, and we pay 40. So we are buying 10% of the 20%. What's the difference that we're taking to equity? What's the difference that we're taking to equity? Let's do a poll. I think this is quite tricky. I will be impressed, those of you who get it right. We have paid 40, and in paying 40, we have bought 10%. So we have bought half of the NCI. Yeah. So we have paid 40 for 10%. The NCI is 30. And I can see quite a few people are shy in committing themselves to an answer. Maybe I'm being slightly aggressive, but actually, having said that, early doors, there's quite a few people getting this right, which is very pleasing to see. I'm going to let it run for a minute or two. Okay, the flurry has broken down. Some people haven't answered. Fair enough. And now I'm giving you 5 more seconds. You don't have to guess. You know, if you don't know, you don't know. It's not a problem. I'm here to explain. I'm here to help. Wow, that's an interesting result. I'm gonna stop it there. Yeah, that's an interesting result. So what's the difference? And it's a 2-horse race. Lots of people, 80% of you, think the answer is 25. It is 25. So 80% of you are correct in some measure. But then half of you are wrong because it can't be positive and it can't be negative at the same time. And there's quite a few of you who didn't respond and therefore not really sure where 25 comes from. So let me try and explain. What we've done here in this control to control scenario is that we have spent 40. There's cash that's gone out of 40. And what we've bought is some of the NCI. The NCI is 30. If we had bought all 20%, if we had bought all 20% of the 30, the difference would be 10. But we didn't buy all 20% of the 30. We only bought 10%. Look, the NCI is 20%. We bought 10%. So we bought a half of the half of the NCI. The NCI is going down by 15. That's why everybody got the 25. Those of you who got the 25, that's how you got it. Well done. I love teaching, so I'm happy. I may have got up at 5 o'clock this morning, but I'm teaching. That makes me happy. Are you happy? Do you like learning? Let's put that to one side. I hope you are happy. Although there's a lot of awful grief going on at the moment, isn't there, in the world with COVID? Let's put that all to one side. In this particular question, we have spent 40. We have spent 40. And we have bought out the NCI of 15. So we have spent lots of money getting rid of a small problem. Does that make you feel happy or sad? What about using the chat box? Does that make you feel happy or sad that you've spent all that money getting it? It makes you sad. We've overspent on the money. I agree with you. Thank you, Nawinda. Thank you, Saranjeet, for making that observation. So it's a negative to equity because we've overspent. It's a net debit. The cash that goes out is the credit, if you like debits and credits. The cash that goes out, money goes out, is credit 40. The reduction in the NCI is, well, NCI is a credit balance, so that 15 is a debit. So the difference is a credit still. It's sorry, the difference is a debit. It's a negative to equity. You don't have to know about the double entry. You don't have to know about the double entry. What you do have to have is an understanding that this is a negative to equity. That is, yeah, ABC done. We're now looking at DEF, and I'm being quiet for 2 minutes. I want you to do DEF. There will be another poll. I know 40% of you got it right last time. I'm hoping more than 40% will get it right this time. I'm trying to convert to a higher percentage. It's a 60% sub. So NCI is 40% and NCI is 40. And we're buying 10%. We're buying a quarter of the NCI. If it's a 60% sub and we buy 10%, then it becomes a 70% sub. It's a control to control transaction. We're buying them out. If we were buying all of them out, the whole of the NCI would disappear, but we're only buying 10/40ths of the NCI, and we are paying 5 for it. In a minute, I'm going to do a poll. There is a difference taken to equity. This poll is making me so happy because I can see many more of you engaging in the poll. I can already see that 70% of you have voted, and votes are still coming in. And I can see an overwhelming response so far of people who are getting it right. This is very heartening for me. Five more seconds on the poll. 5, 4, 3, 2, 1. And I can see there 3/4 of you, yeah, say it's a positive. 3/4 of you say it's a positive of 5. 18% of you say it's a negative of 5. So I think the answer is 5. So we've got over 90% of you coming up with the right number. That's amazing. And then most of you have got it right. So the answer is positive 5. But where do we get that positive 5 from? Let me just try and articulate. We're buying them out. Yeah, we're buying them out. So the 5 that we pay, the 5 that we pay is money that goes out. It's a cash that goes out. All right. And the 5 that we pay reduces the NCI, but we're buying 10%. Yeah, we're buying 10% of the 40%, and the NCI is 40. So we have paid a very small amount of money to get rid of a big problem. The difference is 5. The difference between 5 and 10 is 5. And that makes me happy. It just makes me happy on this occasion that we've spent a limited amount of money, and therefore what we've got there is a positive to equity. Yeah, we've got a credit going through to equity. All right. Well done. Well done. Yeah, it's a net credit. Yeah, well done. Right, time out here for a second because this is very different. Time out here for a second because this is very different. We're not buying out the NCI anymore. We're selling to the NCI. So we've got a 70% sub and we are selling 10%. So the 5 is proceeds. The 5 is cash in. And therefore, we're selling them a slice of the business. I will explain it. There will be a second example, but I'm sort of curious to know if some of you can prove to yourself that you've got this. So we go from 70 to 60. We go from 70 to 60. We're selling 10%. We're selling 10% of the business for only 5. And the assets are 200 and the goodwill is 10. And we're selling 10% of that business. And it's not a profit and it's not a loss because it's within equity. I'm about to launch the poll. And those of you who voted early have voted correctly. Some of you are very quick. Some of you are very good. But again, first time round, the voting is slightly slower. And we're not looking at a 90% success rate so far. That's okay. I'm throwing you in the deep end here. You're having a go. This is a safe environment to make mistakes. Doesn't matter. I don't know who you are. Yeah, you're just putting a, you're having a go, challenging yourself. It's the way it is. A few more people are still voting. Quite a few people are holding back. Fair enough. So we're selling to the NCI. Okay, I'm going to end polling in 5 seconds. Yeah, that's quite a good take-up rate. Yeah, 60% of you have voted. Oh no, a few more. So 2/3 of you have voted. All right, that's okay. And let's see what the results are. So a lot of people have gone for some other number. Eamon, I'm not going to do anything with the raising of the hand. I'm going to ignore that for now. I'm just going to carry on, I'm afraid. And I'd like to say it's not some other number. So 1/3 of you have got that right. I think the answer is -16. I think the answer is -16. Let me try and establish why it is -16. So well done those of you who've got -16. Now the reason it's -16 is as follows. We are selling a slice. We're going from 70 to 60. So we're giving up 10% of the business for cash of 5. And when we're selling, the figure we've got to increase the NCI by is not the NCI balance, it's the net assets. We're selling 10% of the net assets, excuse me, and the goodwill. So we are receiving money in, proceeds, receiving money in, debit cash, we're receiving money in, and what we're giving is we're giving away 10% of the net assets and 10% of the goodwill. So we are selling 21. If you receive 5 and you sell 21, are you happy or sad? Use the chat box. If you sell and you receive 5, yeah, Nicholas, I agree with you. We are sad, aren't we? Yeah. And if we're sad, that makes the difference 16. It makes the difference negative. So sort of think about the idea that if you buy, it's money out. If you buy out the NCI to reduce the NCI, it's money out. But if you are selling to the NCI, then the start of your difference is money in. It's a cash in. So again, we've got here a benchmark, and that benchmark is, I think it was something like 34% of you got it right. And I've now got yet another example. I'm sorry, I'm working you hard, aren't I? I've got yet another example. And this time, there's a trick. There's partial goodwill to which the NCI doesn't participate. Last time it was full goodwill. So we've got a 70% sub, assets are 200, NCI is 40, partial goodwill. So NCI is a proportion of net assets. Goodwill is attributable to the parent only. It's not full, it's partial goodwill. And we're selling 10% of our business, 10% of our business, we're selling 10% of our business for 5. There's another poll. There's another poll. You know what the poll question is going to be. What's the difference? We'll work it out. We've got cash in of 5. We've got cash in of 5 because we're selling a 10% slice of the business, of the net assets. But because it's partial goodwill, the NCI don't participate. Let's do a little vote. Strong, strong. Lots of people getting it right. Some people holding back, but lots of people getting it right. You've got cash in of 5, which is a disappointingly small amount of money, considering you're selling 10% of a business with 200 assets in it. So that's a disappointingly small amount of money. I can't call it a loss. I can't call it a loss. I can't call it a loss. It's not a loss. It's a transaction between owners. So you're receiving 5 and you're selling 10%. Now, last time it was full goodwill. This time it's partial goodwill. So the NCI don't get a share of that goodwill. So it's just 10% of the 200. And I'm really pleased to say that the answer here on the polls is transformed from last time. Yeah. 2 more seconds. Yeah. 2 more seconds. And look at that. Yeah. 3/4 of you smashed it. 3/4 of you got the -15. That's absolutely the right answer. So well done. Now, for everybody else, perhaps those people who didn't vote, perhaps for those people who got it wrong, the money you got in is 5. You're selling to the NCI, you're selling 10% of the business to them. But the increase in the NCI this time doesn't include the goodwill. The reason it doesn't include the goodwill is the goodwill is only partial. So we've got a miserable difference of 15. We're miserable and we're sad, it's negative, simply because, yeah, the money in is too small. So it's effectively a net debit. Oh my goodness me. One last shot. Oh my goodness me. One last shot. Let's see if we can match that 75%. Let's see if we can match that 3/4. We hit the peak of 90%, didn't we, of everyone getting it right 10 minutes ago. So yeah, let's see if we can get more than 75% here. What's the difference taken to equity? It's a 70% sub. We're selling them 10% and we're receiving 60. We're selling them 10% and we are receiving 60. Which seems a lot of money considering it's 10% of the business that you're selling. It's full goodwill. So the slice of the business that you're selling them will include both the assets and the goodwill. Okay. So you know in a minute I'm going to launch a poll. We've got cash in of 60 and we're selling a slice. We're selling 10% of both the net assets and the goodwill. Stick to your guns. Stick to your guns. Yeah. Wow. 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 So many people quick off the mark. So many people getting it right. Wow. Brilliant. Brilliant. Love it. What I also love is that at the moment, something like 83% of you have already voted. So, you know, you're out there, you're engaging, you're participating. This is brilliant. All right, just another moment, just another few seconds to facilitate those people who are a bit slower on the uptake with the maths. And I'm going to end polling. So I'm really pleased with that result. 85% of you smashed it. 85% of you mathematically correctly calculated the difference to equity. So that's really good, because that's the correct answer. And let me show you, for the avoidance of any doubt, how that was calculated. What we're saying is that when you're selling a slice of the business, the money that comes in is 60. When you're selling a slice of the business, the increase in the NCI is 41, because you're selling them 10% of these net assets and this goodwill. So you've got overall an increase of 41. I'm very happy with the difference because there's lots of cash coming in. You're selling them a slice. The NCI is going down. Did I say the NCI is going down? I meant the NCI is going up, because the NCI was 30%. You're selling them a slice, so it will be 40%. So it's an increase in the NCI because we're receiving money. And the difference is 19. And I'm very, very happy. I'm happy, it's a net credit. I'm happy that it's a positive to equity. But actually, more importantly, I'm happy that so many of you got this right. You hadn't got it right before, but now you've got it right. Now you've got something there in the bag. Brilliant. Brilliant. Whoa. Group accounts. Something on group accounts will be there. Something on group accounts will be there. And if it is to do with control to control, and that means buying out the NCI or selling to the NCI, in those different situations, goodwill doesn't change. It's a transaction between the parent and the NCI. There is no way. This is why. Yeah, this is why no profit or loss arises, but there is a difference. So please remember that if you're doing any of those numbers in the exam, the numbers will be different. But in the exam, the explanation of the theory is fundamentally the same. I am pausing for a moment. I am pausing for a moment. I am suggesting a 5-minute comfort break. All right. I am suggesting a 5-minute comfort break. It is a couple of minutes to the hour. And we've been going for an hour and a half. All right. So I am comfortable saying to you that you've done some fantastic work. And I'm going to take my headphones off in a minute, and I'm going to disappear from the screen for a minute, because I am quite literally going to go downstairs and to make myself a cup of tea. So let us take a 5-minute comfort break. We shall come back at 5 past. All right. So we're going to take a 5-minute break. Yeah. So thank you. Yeah, we're going well. We're halfway through. We're learning stuff. Yeah. Keep the faith. All right. I'm going to make myself a cup of tea. Well done. Okay. I'm going to make a start in a minute. Oh, yeah, got another minute before I make a start. So. Okay, just before I do make a restart, two things I mentioned at the very beginning was podcasting. So one of the free resources that I put out there to the ACCA community who are studying SBR is a podcast. And so I discuss on that podcast accounting standards, things that are relevant to SBR. And you can find that podcast, you can listen to that podcast by searching Clendon ACCA podcast. And it's just a slightly different way of revising, getting knowledge in. So if you want to listen to my podcast, it's free. It's available on lots of platforms, Apple, Spotify, Google Podcasts, and others. Just search Clendon podcast and it'll be me. All right. The other thing I said was, if you want to catch me on LinkedIn, I post articles and little study tips, all relating to SBR. So please feel free to connect with me on LinkedIn and have a look at some of my articles and have a look at my history of posting, because you'll then see some information that will be useful to your studies. Right, we've, we're doing well. We've had a short break. My surname is spelt like that, which is a very unusual name. All right, it's a very unusual name. So if you want to search in your search engines for podcast Clendon, yeah, it'll be me. Yeah, Tom Clendon, Clendon. Thank you. Yeah, thank you. It's a very old English name. Anyway, whatever. Let's not talk about it. We've all got a story behind our names, haven't we? That's very kind. Yeah, maybe. Yeah. Maybe I should have put the link. Anyway, you've put the link in there. So if you're, Spotify, it's a good thing. It's a good place. Right. Okay. What are we going to do next? I thought I'd do a little bit on deferred tax. Do I know what's coming up in the exam? No, I don't. I haven't seen the exam. I'm not the examiner. I don't know what's coming up. But deferred tax is always a area that's on the syllabus, and it's always something that can be easily integrated to other accounting topics to make it a layer. Whether you're dealing with, whatever you're dealing with, you've got that potential for thinking about the deferred tax implications of it. So why do we account for deferred tax? How do we account for deferred tax? And then, of course, I'm going to get you to sweat through some examples. So 3 particular examples. In a word, why do we account for deferred tax? And the answer, in a word, is match. Yeah, matching, accruals concept. Strictly speaking, it's perfectly possible for a company to report a profit of 10 million and for it not to have to pay any tax on that. It's perfectly possible for your accounting profit to be 10 million, but for there to be no profits chargeable for corporation tax purposes. So no current tax is assessed. Now, to me, that's crazy, because if I've reported a profit of 10 million, I think the tax effects of that profit should be reported this year and not in the period when the taxman says that we've got to pay it. Because I believe in the matching concept. Now, there's lots of reasons why the accounting profit is not the same as the profits chargeable for corporation tax purposes. Lots of reasons. That's why you have a whole taxation paper. And those reasons have to be fairly generic, because in SBR, we're doing the international stream. And, the examiner the examiner doesn't know Malaysian tax. He doesn't know Vietnamese tax. He doesn't know Hong Kong tax. So he's got to look at it from a very general perspective. But things like depreciation are disallowed. Things like impairment losses are disallowed. These are added back. So why do we account for deferred tax? We account for deferred tax because of the matching concept, because of the accruals concept, because we want to report the profit, and the tax effects in the same period. We want to pair the two together. That's why we account for deferred tax. So let me give you a small example. Yeah, can you see these pair of tattoos? What film did that come from? Yeah, anyone remember that film? Came out a few years ago. That's John Travolta, I think. Yeah, no, you're not a big film fan. Quentin Tarantino. Yeah, I think it's Pulp Fiction. If you haven't seen Pulp Fiction, I'd recommend that you see Pulp Fiction. Anyway, let's not talk too much about that. We've got a revaluation gain of 10, and we've got no current tax assessed. Now, I believe in the matching concept. If you're accounting for deferred tax, if you're accounting for a gain of 10 and no current tax has been assessed, all you've done is defer the payment of that 2000 tax. If I'm reporting the gain in OCI, the gain, that revaluation gain, that non-cash income, I can understand why it's not currently assessed for tax. It would be grossly unfair to have to pay tax when you've got no money coming in. So in this situation, you would want to have an extra expense of 2000. You'd want that 2000 expense to match with that 10,000 gain. So you report a post-tax gain of 8. That's the theory. Now, you haven't paid that tax. The payment of that tax has been deferred. The payment of that tax has been postponed, which is why you then have a deferred tax liability. So I'm accounting for deferred tax very much involved in the matching concept. I'm matching the gain with its tax effects. Time out for a second. If the gain is in the P&L, the tax is in the P&L. If the gain is in OCI and reserves, the tax is in OCI and reserves, because we're matching. Because revaluation gains, if they are PPE, are probably in the probably in OCI and reserves. Or if it's fair value through OCI investment, it's in reserves, it's in OCI. But if the gain is to do with an investment that is fair value through P&L, then you would take it through P&L. So matching, matching, matching. If you didn't account for deferred tax, then there would be certain gains which would be reported pre-tax, and that would not be a faithful representation of your performance. You shouldn't be mixing up profits that are pre-tax and post-tax. It just doesn't make sense to aggregate them. So we've got to report, we've got to account for deferred tax because of the matching concept, because it creates a faithful representation to ensure that all of our profits are post-tax. And if we were to miss out deferred tax, we would be incomplete. And if we're incomplete, we're not giving a faithful representation. We're also, in recognizing a deferred tax liability, saying in the future, we've got to pay this. So you're pointing to the future, you're being relevant. You're predicting a future cash outflow. Time out for a second. I assume you really do know relevant information and faithful representation, because they're key to useful information. The framework wants information to be useful. Information is only useful if it's telling the truth, if it's a faithful representation, and if it's relevant. So why do we account for deferred tax? Reason number one, matching. Reason number one, matching. Reason number two, to be complete and faithful. Yeah. Reason number two, to be complete, because we want to include all of our liabilities, and to be relevant, because we are predicting that this is going to be a cash outflow. So I'm linking things to the framework if I can. Why and how are two different questions. So we talked about why we account for deferred tax, matching. Why we account for deferred tax, matching. Relevant, faithful. How we account for deferred tax is kind of Deferred tax is accounted for on all year-end temporary differences between the carrying value of assets and liabilities and their corresponding tax base. I mean, virtually any question on deferred tax probably sees you write out that sentence, dump it down very quick, try and soften it with the definition, and soften it with information in the question. But deferred tax is accounted for on temporary differences between the carrying value of our assets and liabilities. The carrying value of our assets and liabilities are the figure in the books, whereas the corresponding tax base is always a bit of a mystery. It's the figure as acknowledged for taxation purposes. And if they are taxable temporary differences giving rise to gains, this is a deferred tax liability. Please notice the emphasis. Please notice the emphasis that what I'm talking about is having, taxable temporary differences where you're delaying the payment of tax. And examples will include gains, examples will include accelerated capital allowances. It's slightly dangerous to just kind of, rote learn lots of examples. It's much better to be able to understand it. So that's how we account for deferred tax liabilities. And these arise when the carrying value of our assets is greater than the tax base. Yeah. When the carrying value of our assets, the figure in the books, is bigger than the amount for taxation purposes. But again, there's the idea of a yin and a yang, because if you've got a deferred tax liability where you've deferred the payment of tax, there can be an acceleration of the payment of tax. So if we're dealing with losses here, you can, get loss relief in the future. And this is where we start talking about deductible temporary differences, where the carrying value of the asset is smaller. A question that's just come in: if we're not sure, can we just mention deferred tax? Yes. But I would like to hope after this conversation, you are going to be sure. you will get off the fence. So let's see. Yeah. So when you've got deferred tax assets, it's because they're deductible. Something's gone wrong. There are losses. Yeah. There's accrued for disallowed expenses, because this is where the carrying value of the asset is smaller than the tax base. We've written the asset down. We've charged all those non-allowable expenses. We've got the asset being so small compared to the tax base. There's a loss which the taxman ignores. Or we're recognizing a liability which the taxman doesn't. So the taxman may only give us tax relief when we pay something, but we've charged it in the P&L. So we recognize the liability, but the taxman doesn't. And therefore, we have effectively accelerated the payment of tax. This slide maybe is worth pausing on. If we're dealing with accounting gains, our assets are inflated, but we're not being charged tax on it. If our assets have been inflated, but the tax base remains the same, there's a taxable temporary difference and a deferred tax liability. You know, we need to tie those words together. 2, 4, and 6 are all even numbers. Gains are taxable, have a liability. 1, 3, and 7 are all odd numbers. Losses are deductible, give rise to an asset. So make sure that you tie a consistent approach. Gains are taxable, that give a liability. Losses are deductible, that give a deferred tax asset. Link the language together, please. Link the language together, please. Time, I'm hoping for a poll. Time, I'm hoping for something for you to do. Pen and paper. I won't reveal the poll for a minute or two, but at the beginning of the year, the net book value of the plant was $500,000. At the beginning of the year, the tax base was 400,000 at the beginning of the year. During the year, depreciation of 50, and during the year, tax allowances of 80. So depreciation is disallowed. Depreciation reduces the carrying value of the plant. The tax allowance will reduce the tax base. Tax rates are 20%. What's the deferred tax liability? 2 minutes. Please, can you work it out? So at the start of the year, so I want to know if we're accounting for deferred tax, we're accounting for deferred tax liabilities, says a liability, on our year-end temporary differences. The year-end temporary difference between the carrying value of the asset. Now, at the beginning of the year, it was 500, but then we charged depreciation. And at the year end, the tax base. At the beginning of the year, it was 400, but then we claimed capital allowances. So we've got a difference between the carrying value and the tax base, and we've got a tax rate of 20%. I am fairly hopeful that you're going to get this. I'm fairly hopeful you're going to get this. Or just say, I'm slightly worried about the question now, if I'm honest with you, because the question says, what's the year-end deferred tax liability? And then one of the questions is an asset. So that's a little bit annoying. So, oh dear, have I done something horrible here? Anyway, we'll have a look. We'll work it out together. Just give it a guess, give it a go. Yeah, no harm done. Let's try and work it out. And I'm frustrated because actually the answer isn't one of those polls. So I'm going to end the polling there, and I'm just going to apologize because I don't think that was a valid poll. So I'm not counting that one. Yeah, I'm just forgetting that one. I'm going to try and build this one from scratch. What's the year-end deferred tax? So what we've got to do is build the answer. So we've got to build the answer to get the year-end carrying value to be 450. I don't think that's controversial. I think we've got to build the answer to get the year-end tax base to be 320. I don't think that's controversial. I think, therefore, that gives us a year-end deferred tax liability of 26. And actually, I don't think that was an option under the poll. My apologies. I've made a mistake. We learn from those mistakes. Not an issue. Yeah. So it's a deferred tax liability of 26. Fadley, absolutely. Fadley, absolutely. It is a deferred tax liability of 26. And you can see the logic there. You can see the logic there. And I don't think that was one of the answers. I'm not going to go back and have a look at the poll. So yeah, apologies for that. We've got a couple more polls, so hopefully they'll be correct, and you can also be correct. Now, as an aside, purely as an aside, you had an opening deferred tax liability of 20. So if you've got a closing deferred tax liability of 26, this will generate for you an expense, an increase in the deferred tax liability of 6. So just following it through. Got to be a little bit careful we don't get obsessed with the numbers. So the answer I was looking for was 26. And it's a deferred tax liability because the carrying value of 450 exceeds the tax base. It's like you've revalued the asset upwards by 130. 130 times 20% gives you 26. So the balance sheet liability is 26. That's a non-current liability. An asset is clearly damaged, ergo impairment loss. It has a carrying value and a tax base of 100, but you could sell the asset for 60, but it has a value in use of 70, and the current rate of tax is 20%. Now, in an exam, I can talk through the theory that you would be writing and explaining, but in terms of creating a poll, the poll's going to be pretty brutal in terms of year-end deferred tax. So work out the year-end deferred tax, yeah, which means working out the carrying value of the asset, which means thinking about the tax base of the asset to get the temporary difference, thinking whether it's deductible or taxable, and thinking, yeah, what that means from a balance sheet point of view. So let me give you a minute. So voting has commenced. We have a damaged asset, and before the accounting was done, the carrying value in the tax base was 100. Now, the damage means that we can only sell the asset for 60, and it has a value in use of 70 with a current rate of tax of 20%. So what's happening here, I think, is there's an impairment review. Now, the impairment review will affect the carrying value of the asset. So an asset is impaired when the carrying value exceeds the recoverable amount. So with the asset in the books at 100, but you can only recover 60, or you'll take the 70. You take the higher. So you can only recover 70. So the impairment loss is 30. So we're writing the asset down to 70. The impairment loss is 30. So the carrying value is 70. But the impairment loss is ignored for taxation purposes. So therefore, the tax base remains at 100. You've got a carrying value of 70. The carrying value of 70 and a tax base of 100, you've got a temporary difference of 30. It's a loss. It's an impairment loss. The tax relief is going to be in the future. It's a deductible temporary difference. It's a deferred tax asset. And I'm so pleased that 3/4 of you have got this right. Amazing. Amazing. Yeah, let me show you how good you are at deferred tax. 72% of you got the right answer, that the deferred tax is 6 million as an asset. Well done. Well done. All right. So a few of you fell into a trap. 13% of you thought it was a liability of 6. It's not, it's an asset because it's a loss. And, you know, I can further explain that. You know, in an exam, it is about, first of all, identifying the fact that the damage is an impairment review, that you write down an asset to its recoverable amount. The recoverable amount is the higher of the fair value less cost to sell and the value in use. And if you could sell it for 60 and you keep it for 70, you keep it, you recover 70, you minimize your loss. Your loss is 30. Makes sense? Now, you have deferred tax complications here because the 30 million is written down against profit, reduces accounting profit, but is ignored for taxation purposes. So the tax base of the asset remains at 100, and you've therefore got a deductible temporary difference of 30. Can you see how this question could very, very easily be set for 4 marks? And you're then having to articulate that you've got a deferred tax asset of 6. You're debiting the asset by 6. You're effectively crediting the P&L by 6. So the loss of 20 is going to be matched with the tax implications of 6, so that you've got a post-tax loss of 14. I'll say that again. I'll say that again and I'll get the numbers right. The loss is 30. The loss is charged against profit. The tax implications of that loss of 30 are 6. So when you set up the deferred tax asset of 6, you're debiting the asset by 6 and you're crediting the P&L by 6. So that means in the P&L, you've got your loss of 30 and the tax implications on that of 6. So your post-tax loss is 24. You're matching. Well done. Yeah, 74% of you got that right. You identified that the loss created a deferred tax asset. You identified that you got a deductible temporary difference, and it was numerically 6. So I'm very pleased. I think we've got another example coming up. Ooh, this is tricky. This is tricky, tricky. You're going to have to read this question. You're going to have to think, but you kind of know what the poll's going to be. You kind of know the poll is going to be asking you whether you've got a deferred tax asset or liability and how much it is. So you can work it out before you even see the poll. It is 1 month before the year end. A detailed reorganizational plan has been agreed. The directors are considering whether to publicly announce this in 2 weeks or in 2 months. The cost of the reorganization will be 200,000. These costs will only be deductible for tax on a cash paid basis. Current rate of tax is 30, but they have announced a proposal that the rate in future will be 25. I think this is quite realistic in terms of the exam, because you're integrating here provisions, ISA 37, with ISA 12, income taxes and deferred tax. And although the question says or explain, I'm in the poll going to be looking for a very crude number, because the nature of the feedback is if we can distill it down into a number, then and you get that number right, I'm assuming you can understand the build up. If we assume the provision goes ahead, if we assume the announcement is made, yeah, then we're looking at what deferred tax on the balance sheet. Gosh, quite an interesting one. So just another minute. I'm not sure of the answer myself here, in that there is a debate about the answer, or there would need to be an explanation about the answer. Okay, I think the voting is dying down. There's a few of you not yet voted, but that's okay. You don't have to vote. You may be away from the desk at the moment. But we've got nearly 80% of people voting, so that's good. And what this shows me is that we've actually got quite a wide range of results. That, some people think it's a deferred tax asset. Some people think it's a deferred tax liability. Some have used 30%, some have used 25%. So the majority of people think it's an asset. So 31 and 31, 62% of you think you've got a deferred tax asset. All right. Whereas the rest of you, the 19 and the 19, think you've got a deferred tax liability. And then you've got a split between those who are using the 30% and those who are using the 25% tax. So I kind of understand where the numbers are coming from. So Yeah, some of you have got it right, but to be honest, most of you have got it wrong. But it's the debate, it's the explanation that is much, much more important than the final answer. So let me go through how you would kind of build up, how you would sort of build up your answer there in this scenario. So I think the first thing I would deal with is the accounting issue of making a provision. All right, and in a written exam, in an exam which was worth 4 marks or so, there's only actually going to be 1 mark for the calculation of the deferred tax, because there's going to be 3 marks for the discussion. And the accounting issue that we're dealing with here is the idea that, you know, ISA 37 says, do we have a present obligation? Do we have a liability of uncertain timing or amount? Have the 3 conditions been met? And the answer is, it's not 100% clear cut, but you would only have a provision, you'd only have an obligation if the announcement was made before the year end. If the announcement was made after the year end, that's a non-adjusting event that doesn't create additional evidence of conditions existing at the year end. So to make a provision, you have to get it out there before the 31st of December, before the year end. You have to raise that valid expectation. So in order to carry on with the deferred tax story, you sort of assume that the announcement is made 2 weeks prior. All right, the year end. Now, there is a deferred tax implication to that, because the costs are only deductible when the cash is paid, and you haven't paid the cash this year. You've charged it this year, so you've reduced your accounting profit this year. You've established a liability this year, but from a tax perspective, the expense is added back. From a tax perspective, the liability has a nil value. So what you're looking at is you're adding back, you're dealing with an accounting loss. You're dealing with higher profits chargeable for corporation tax purposes. You're paying more tax. You're paying more tax. Now, it's a temporary difference, so you will get the tax relief in the future. So the majority of you were talking about this being a deferred tax asset, and you are correct, because the carrying value of the liability exists with a nil tax base. If it was a carrying value of an asset with a nil tax base, it would be a deferred tax liability, but it's actually a deferred tax asset in this context. My challenge is to which tax rate to use. And I'm not 100% sure which one to use. In theory, we use the future rate. In theory, we use the rate of tax which will be applicable when the temporary difference reverses. So we've got a future rate of tax of 25%. But normally, the current rate of tax is indicative of the future. Now, it depends on your government. When I lived in Singapore, if the government said they were going to do something, they always did it. They had a majority. It was clear cut. If you look at that wording of the question, is it certain? Is it reasonable that the tax rate is going to go through? They've announced a proposal, and there's a judgment there about whether the government will enact that. Has it been substantially enacted? I'm going to say no. I'm going to say that 25% is not substantially enacted. It's not highly probable, because it's a proposal of the government that they haven't yet got through. So on that basis, I will use the current rate of tax as my best estimate. And on that basis, I think the answer is 60,000. Yeah, deferred tax asset of 60 million. So well done if you got it right. If you got it wrong, I don't care. It's a learning opportunity. And actually, if there are 4 marks available, you could still potentially get all of the marks if you sort of build up your logic. Yeah, get 3 out of 4. Yeah. I like it. I like it. I like what you've done. Yeah, I like what you've done. Now, what have we got left? We got 45 minutes left, and we still got another little topic to go. Yeah, we still got another little topic to go. So having put an expense through the P&L, you're looking to put a credit through the P&L. In the question, the announcement was to the public, not to those affected. Should we still recognize the provision? That's a good question. Those affected are members of the public, in the sense that if you put out the press release to the newspapers and you talk to the trade unions, you are effectively. So the answer to that question is yes, Lee. The answer to that question is yes. You've got to raise the valid expectation. So by telling the world that you're going to do it, and if you do that before the year end, you've raised the valid expectation. Absolutely. Good question. Thank you. So we've looked at deferred tax as to why we account for deferred tax matching. Why do we account for deferred tax? To faithfully represent all of our liabilities. Why do we account for deferred tax? To be relevant, to include the prediction of a future cash flow. We account for deferred tax to ensure that all profits are reported with the tax implications to hand. That's why we do it. How do we account for deferred tax? We account for deferred tax on all of our year-end temporary differences between the carrying value of our assets and the tax base, between the carrying value of our assets and liabilities and their corresponding tax base. If we revalue an asset upwards, we have a gain, which is taxable, and liability. Gains are taxable, deferred tax liability. Losses are deductible, which create deferred tax assets. So there's a certain yin and yang going on there. Two minutes. I'm not going anywhere. I'm just saying that we're about to look at a new topic. 2 minutes. Just a very quick comfort break if you need it. 2 minutes. If anybody has any particular questions they want to ask in the chat, now would be a good time to get one in early, or if you haven't yet connected with me on LinkedIn, now will be a good time to just quickly connect with me on LinkedIn, and to remember that you might want to look at the podcast at some stage. 1 minute break, 1 minute. I will be talking again in 1 minute. New topic coming up. Okay. One of the things that comes up in the exam is current issues, and current issues is a very wide topic, and sometimes the examiner talks about current issues in terms of the framework. And sometimes it's just very left field, and you've got to be able to react. So I'm going to look at a topic here which is to do with crowdfunding. And it may well be that none of you have done this before, because I don't think it's particularly in the BPP manual. It's not particularly in the Kaplan manual. But you know what? That doesn't stop the examiner being creative and coming up with a real life practical situation. Now, crowdfunding is an example of disintermediation. You know, traditionally, a company, if it wanted lots of money, would have to either go to the stock exchange to issue equity shares or to the banks in order to borrow money. But crowdfunding is a way of collecting cash from the crowd perhaps through the internet. So you cut out the middleman, you cut out the stock exchange, you cut out the banks. So crowdfunding is a way of getting money in from a variety of individuals. That's really all that it is. Now, the challenge or the problem that we face as accountants is there is not an IFRS. There is not an IFRS on crowdfunding. So we need to understand the substance of why we've got the money. If somebody has paid us money, we say thank you, debit cash. But why have they paid us that money? What is that? What is that for? What is that about? So we will need to think, we will need to reflect, and we may need to think about the basic principles of the framework. I mean, why do people give us money? Customers give us money if we sell them things. If we borrow money, we have to pay it back, or shareholders may be subscribing to shares. I mean, or I suppose it might be a gift, but you know, the three main reasons why you have received money is because you're creating an obligation to pay it back. You've borrowed it, you've sold them something, or you've given away ownership. And so crowdfunding isn't really a topic. It's a coat hanger for saying, can you work out whether it's a liability? Can you work out whether it's revenue? Can you work out whether it's equity? It's a kind of game. Back to the framework, back to basic principles. And I'm going to test you. Once upon a time, 1 week before the year end, there's a crowdfunding campaign. And the campaign raised $100,000. And we were charged 10%. So each contributor paid $100. And with that $100, they were immediately issued with a kit, and they became eligible for a service later on. So they got a product straight away, and they got a service later. At the reporting date, all the kits have been dispatched, but the service of marking the exam hasn't happened yet. If you want to buy the kit individually, you physically pay 60. But if you want the service at a later date, then individually you pay 90. Thank you. You've anticipated my next moment. Thank you. Yes. It's revenue, isn't it? So in a sad way, in a simple way, forget crowdfunding. We're now spending a few minutes revising revenue recognition, IFRS 15. Step 1, do we have a contract? Yes. Step 2, we have 2 separate performance obligations. Don't we? Because we've got the performance obligation to deliver the kit, which is a physical product where the timing of the recognition is at a moment in time when control passes, which I think we've done. And we've also got a service which hasn't yet been delivered. So we haven't fulfilled the performance obligation yet. I'm sort of hoping some of you are working out the split, because when you've got a single contract, a single receipt of money, $100 or $100,000, when you've got that single contract, that single receipt, and you have got two performance obligations, you've got to somehow split the transaction price between the separate performance obligations in the proportions of their standalone selling prices, because these are two distinct products, aren't they? It's distinct from a kit, which is something physical, to a marking service, which is something totally different. And they can be sold separately. The kit is sold for 60, the marking service is sold for 90. And therefore, more of the revenue should be allocated to the marking than to the kit. So logically speaking, what we're thinking is, why have we got the money? Revenue. Which element is being accounted for? Yeah, revenue, it's income. What are the principles, the 5 steps? Where do we credit? In substance, we have made a sale. In substance, that means we've got to think about the 5 steps, and we've got to unbundle the transaction because there are two distinct performance obligations. Let's see if there's a poll. Let's see if there's a poll. And the poll is going to ask you the revenue that you would recognize in this situation. So I don't know whether you've been able to work that out, whether you anticipated this question, or whether I'm just being very harsh with you. I don't know. But hopefully you can see the information, and we've received this 100,000, and nobody's saying it's 100,000 you recognize as revenue, because you all acknowledge that some of that has got to be allocated out, yeah, to the service, and you haven't fulfilled the service obligation. So how much revenue can you recognize? And looking at the numbers that I'm seeing of the people who have voted, most of you are getting it right. The answer isn't 100,000. Just because you've received 100,000 doesn't mean to say that you can recognize revenue of 100,000. It's not 100,000, because there are two distinct performance obligations. The kit you've delivered, but you haven't marked the scripts. So you haven't fulfilled that performance obligation. So the answer is not 100,000. That is not the revenue that you can recognize this year. You've got to allocate the 100,000 in proportion to the standalone selling prices. Now, a revision kit sells for 60 and a marking service sells for 90, but you've sold them both for 100. So that 100 has to be allocated between the kit and the marking, and more weighting goes on the marking. So the way I will work this out is I will add 60 and 90 together to make it 150. And then I will say, well, of that 150, 60 150ths is to do with the kit. And we have fulfilled the performance obligation of the kit. So those of you who've answered, it's quite tight as to what the answer is. what the correct answer is. I'm giving you 30 more seconds. No, I'm not giving you 30 more seconds. I'm giving you 3 more seconds. 1, 2. Well done, 44% of you. Well done. It's the most popular answer. Yeah, that the revenue that you can recognize. So first of all, crowdfunding can be revenue. If you're selling them something, it can be revenue. The 100,000 comes in, but that revenue is 2 performance obligations. So we've got to split it into it. We've got to split the transaction price to the separate performance obligations in proportion to, yeah, the standalone selling prices. And how have I got to the 40,000? How have you got to the 40,000? Well, the commission is an expense. The commission is an expense, but the gross revenue, yeah, is based on the gross revenue is based on that. So let's yeah, the transaction price. So the commission is an expense. The transaction price is based on 100. So they've got one kit, yeah, and so that's the separate performance obligations. Yeah, and you've got to separate them out. And therefore, when we come to do it, yeah, what we've actually got is money coming in of 90. We've got expenses of 10. So the expenses are recognized of 10. The revenue that we're getting in is 40. You see the 150 is 90 plus 60, and of that the kit is 60, and therefore the remaining, yeah, deferred income, a performance obligation that we've yet to satisfy, is 60. Okay. Yeah, good. Okay. Different scenario. Whoops, different scenario. Please, can you have a look? Please, can you have a read? Oh, it's going to give me a headache, this one. We're doing a crowdfunding campaign. We created a website. Campaign has raised 10 million. So we got 10 million coming in. We charged a commission. So yeah, maybe we only get 9 million in, but the gross amount of money is 10. And they're issued with a new class of non-voting shares. They're issued with B shares. And dividends are payable on the B shares. Oh God. Dividends are payable on the B shares if and only if they've been paid on the A shares. Now the A shares are equity shares. So there's no obligation to pay a dividend on the A shares. And the B shares only get a dividend if an A dividend has been paid. and then they get the same amount. So they're not ahead of the queue. They don't have an obligation to receive a dividend. But if A shares get a dividend, then B shares get a dividend too. The B shares have a call option. A call option, which allows Clendon to redeem it, allows Clendon, I am Clendon, I am the company, I have received the money, I have a choice, I have an option that I can call these back. It's not a put option, it can't be put onto me, it's a call option. I am in control. What do we think's going on here? Yeah. Lee thinks equity instrument. Yeah, Lee thinks equity instrument. Any other thoughts at this stage? Maybe I went a bit quick. Yeah, it is, the challenge is to think about this. Yeah, it's ISA 32. Yeah, it's not share-based payments. It's ISA 32. It's is it debt or is it equity? We've issued these shares, but don't be looking at the legal form. Look at the truth, look at the economic reality, look at the substance. Do we have an obligation to pay the money back? Or are there no obligations? So the Class B shares, there's no obligation to pay a dividend as far as I can see, because there's no obligation to pay an A dividend. And in terms of the Class B shares, the call option, I've got control over that. I've got control over that. So why does the company receive money? Yeah, the accounting issue that we're talking about is whether it's debt or equity. And you're going to get marks in the exam for setting the scene. You're going to get marks in the exam for reminding about the definition of debt, an obligation, reminding about the definition of equity, ownership interest, no obligation, saying that we've got to take into account the substance and the faithful representation, then beginning to talk about the dividend and the option, and then coming up with a conclusion. So it's a 4 or 5 mark analysis of the question. And I've got a crude, and I mean crude, sort of poll, yeah, for you to think about. What do you think? What do you think? Debt or equity? Yeah, let's live in a simple binary world. Yeah, and the world is not binary. The world is not simple. The exam is not straightforward. It's a debate, it's an explanation, it's a discussion, but we've got to come off the fence in using our judgment at the end of the day to arrive at a conclusion. Debt or equity? Most people have voted, but there's still a few more coming in. Most people have voted. Yeah, I agree. I don't think there is an obligation to B, because we don't have to pay a dividend to A. So yeah, I agree with that comment or observation that's coming in. So yeah, in this simple binary world where 80% of people have voted, the vast majority of you are saying it's equity. And do you know what? I think it is equity. I think it is equity, because I can't see that we have to exercise the option to call it back. We don't have to pay them a dividend, so we got no obligations. So it's shares, so it is equity. That would be my conclusion. But more importantly, it's the justification for the conclusion. All right. So yeah, let's bish bash bosh. Yeah, they're the key facts. They're the key facts. That's the key issues involved. Yeah. There's no obligation to pay the dividend. It's a call option, which means I am in control. I'm in control. Yeah, the Class B shares contain a call option. I'm in control. Clendon has that option. All right. So the conclusion is, yeah, it is the issue of equity. It is the issue of equity. So well done, most of you. Well done, most of you. And I hope those of you who were thinking it was debt now understand why it's equity. But you've also got to think that, you know, this is not a multiple choice paper. You know that. You've got to structure your answer by building to a conclusion. There's another one. There's another one. Have a read. Have a read. There's another one. Same, but different. So we're issuing a crowdfunding campaign. We get 20 million, 10%. So there's transaction costs of 18. Transaction costs of 2. So the net proceeds are 18. Now these are Class C shares. Now we're creating Class C shares, and these Class C shares, Clendon is obligated to pay dividends at a fixed rate to C. Obligated to pay dividends at a fixed rate. And you can't pay a dividend to A until you've paid the fixed dividend to C. So C is somehow a preference share, I suppose, and they're getting a fixed rate which you're obligated to pay. Now, Class C contains a put option. Now, the put option means that it can be put on to me. The power is held by the investor. The investor can require repayment of the initial investment at any time. And if there have been any arrears of dividends, they're due those arrears of dividends. Wow. That's the story. And I think you know where this is going. I think you know this is going in the context of a poll. So you need to be thinking about this. And then clearly in an exam, it would be a written answer. It would be 3-4 marks. What's going on? Yeah, because if you have a financial instrument, yeah, you'd have to think about that. All right, so I'm just giving you a moment. So a crowdfunding is not a gift. I mean, it could be a gift, and in which case you treat it like a government grant. But this isn't a gift. It's not revenue. It's down to ISA 32. Is it debt? Is it equity? That's the challenge. That's the area that you're thinking about. And so the same questions keep on being asked. Why have you got the money? What's the truth? What's the substance? What element is what we're being created? Where are we going to credit this transaction? What's going on? And you know, the challenge is that this is either debt or equity. It's clearly we're not selling goods or services. It's not a receipt of a gift. Yeah, there seems to be a financial instrument that is being used. And, you know, we've had an amazing contribution that you've been making to this presentation. And I've enjoyed it because you have been engaging and because I have seen your poll results improve and improve. And this is our last poll result. And wouldn't it be good if we had, the best result in our last one? I think the highest one we had so far was 90% if you got it right. And we converted something a 40% to a 78%. We've been really adding value. We've been really having a good session together. And it would be really good if everybody voted on this one. So far, I can see that something like 3/4 of you, over 100 of you have voted. And there's a few more votes coming in. So I'm just going to give it a countdown. 5, 4, 3, 2. Five, 4, 3, 2, 1. What is going on here? Let's have a look at the overall results here. Look at that. Look at that. 96% of you correctly identify that what's happening here is there is debt going on. Yeah, there's debt going on because we believe in the truth. We believe in the way and the light. We believe in following the faithful representation. We're not observant of the law, we're observant of the truth, which is a deeper concept embedded in the framework. So yeah, well done. Yeah, well done. And let's just recap on why that is the case. Although I think it's the case because we have an obligation to pay effectively interest. The dividends are in substance interest, so they will be accounted for as a finance cost. The money you are receiving, the net proceeds of issue of 18 million, debit cash 18 million, credit non-current liabilities 18 million. And then the fixed dividend is an expense that you charge against profit, even if you don't pay it, because you're obligated to pay it. The put option is further evidence in support of the idea that what you're looking at here is an obligation to repay, an obligation to put the money back, in the hands. They've got the power. So I would have to jump if they wanted their money back. So from their perspective, they're not really buying into the risk and reward of the company. They're looking for a fixed return, where they feel reasonably comfortable. That is the nature of debt, fixed term. So it is debt, fixed return. And that's it. There we are. I've left deliberately a few minutes at the end. But what a lovely poll to finish on, where 96% of you were smashing it. And that's, it's not easy talking about financial instruments. It's not easy dealing with faithful representation. It's not easy going for 3 hours and then still being strong. So these exams are not easy. All right. So they need to be treated with respect. A put option, the power is with the investor. They can put it back onto you. If it's a call option, I have the ability to call it back. So yes, that answers that question. So with regarding to ISA 12 for the tax rate that will be substantially enacted after the year end, will the current tax be based Will the current tax be based on the tax after the year end or the tax before the year end? Your current tax assessment will be based on the current tax rate. The deferred tax liability is based on the future rate. But you're never going to have to calculate the current tax liability because that's the whole of the taxation paper. So the deferred tax rate that you use, in theory, is the future rate, but you never really know what the future rate is. So you have to guess and extrapolate based on the current rate, unless there is a proposal which has been substantially enacted. That's the key word in the standard, substantially enacted. So Jenny says, is it important for SBR to know every calculation? I'm going to say no, because you don't have to get 100% in the exam, and the exam is primarily a written paper. Having said that, some of the easy marks are some numbers, and so you've got to know the pro forma of how to calculate goodwill. You've got to know the pro forma as to how to calculate a gain on disposal. You've got to know the pro forma as to how to calculate an impairment loss. You've got to know the pro forma for control to control, because if it comes up, you need to just dump down that pro forma and then slot in the numbers. You need to know the pro forma for amortized cost. You need to know how to calculate a deferred tax liability or asset. Is that it? Is that it? Are there other calculations involved? Yeah, you've got to know how to calculate share-based payments, whether they're equity settled or cash settled. But segmental reporting, no, you're not going to get numbers on segmental reporting. Integrated reporting, no, you're not going to get numbers on integrated reporting. Cash flow, yeah, you've got to be able to know how to calculate cash flows and where they go. But I'm struggling. Provisions, it's all chat, isn't it? Impairment, you've got to know the little pro forma for the impairment. Carrying, well, you know, an asset is paid when the carrying value, recoverable amount. But it's not debits and credits. It's not preparing full sets of accounts, Jenny. You've got to be able to discuss and explain. Annie Helm says, will merely stating the definition award any marks? Maybe. But I tell you what I would want you to do is to soften the definition. I tell you what I'd like you to do is, instead of brain dumping, instead of reiterating, instead of being Google or Wikipedia and dumping down a definition, I'd like you to use the name of the company in the question, pick up something from the question and explain why that definition, that particular thing is applicable, and then you will get a mark. If you find yourself in the exam closing your eyes and writing out stuff that you've pre-learnt, you're probably not answering the question, because the question is unique and you need to address the question, answer the question. So it's about applying your knowledge. Yeah, it's about applying your knowledge. A question about the impairment of goodwill and the deferred tax implications of that. No, there are none. It's an exception. So the impairment loss, so goodwill is ignored totally for deferred tax. So any impairment loss, just ignore it. That's what the standard says. And that's because, if you want to know, that's because goodwill appears in the group accounts, and the group is not a tax entity as such. It's the individual companies that pay the tax. So we just ignore that. Okay, if we got the calculation wrong, but we stated the explanation well, you will pass. You will pass. You will pass on the explanations being well. The calculations are largely the icing on the cake. And it's actually possible. The own figure rule applies. if you calculate the goodwill incorrectly and then you do the impairment review, of course the impairment loss is going to be wrong. Of course it is, numerically. But if you do the right thing to the wrong number, you get the marks. If you do the right thing to the wrong number, you get the marks. It's the method that's important. So don't just put numbers down on the page, because a marker has to know why you're doing it. Always write down what you're doing. Oh, I've got some other questions which have come in on the Q&A side. Yeah, okay, I think I've answered those. Yeah, that's fine. Okay, I've still got a couple of minutes. I think I've answered the questions that have come in. I don't think I've missed any. Can the SBR answer be answered in the same way as SBL? Ooh, I don't know what that means, because I don't teach SBL. And I know that there's lots of professional marks in SBL, and I know that it's really important in SBL that you have reports and whatever. In SBR, which is what I'm talking about, you just need to write in short, sharp, simple sentences. There's no need for any fancy report formats or anything like that. Yeah, think about your written presentation. We established earlier that everybody was doing the exam in the paper way, so your handwriting needs to be neat. Your handwriting needs to be legible. If you write nothing in the exam, I guarantee you will get no marks. Simple. If you write something, you will probably get a mark. If you write something, you will probably get a mark. All right. So it is frustrating as a marker looking at scripts and seeing that you're marking the script out of 75 or you're marking the script out of 80 because so much of it has been left. And so a student is really pushing uphill to get through if they don't answer all parts of the question. So it is about time management. I think at this stage of the game, being so near to the exam, it's more important that you do exam questions to time and you improve your exam technique than you suddenly pick up, oh, I don't really know about pensions. I better start learning about pensions. You should be revising. This last week is about revising your revision. Oh, there's been a couple of questions gone by. For the impairment of partial goodwill, where notional goodwill is needs to be calculated, do we have to allocate the impairment loss for the notional? Yes. Yeah, short answer to that question is yes. There's a real hassle with NCI being measured as a proportion of net assets, because which is fine, but when you do an impairment review, you've got to notionally gross it up so that the net assets are always there. They're there 100% of them. The goodwill is then grossed up notionally only in the impairment review process and the recoverable amount. And then you get a number which is not quite right because that number includes the notional NCI. So yes is the answer. How to get the professional marks? Several ways. Giving a full answer, giving a good answer, giving a considered answer is going to get you the professional marks, as opposed to an incomplete answer and a sloppy answer. So it's a little bit that the rich get richer and the poor get poorer. It's a little bit of that going on. But I think particularly with ethics, it's about linking it to the ethical code. It's about making a specific reference to the word integrity being important, being an ethical code issue, or competence being, and it's in the right context. You're not just writing these words randomly. You're picking them up. So you're getting professional marks on the ethical side if you're giving a good answer, a mature answer, a reflective answer. Can we put in short forms? Yeah, I think the ones that you mentioned there are okay. You don't want to make up your own ones. So yeah, I think FV and, you know, I recognize what they are, and a marker would recognize what they are. I think the one thing that I would just caution you against slightly is things like CGU. If you're explaining to an investor about the impairment process and you start using jargon like CGU, they're going to be lost. So, you know, the exam is aimed at is not if you're writing, you're explaining to somebody else who's intelligent. So you say it's a cash generating unit, which means it's a collection of assets that together generate an independent stream of income, and then you're going to get a mark. But if you just say CGU, that's a false abbreviation. I think we've been going for 3 hours. I don't want to be too strict on the time, but can we just write ISA 37 rather than the full name? That's a good question. Do you know what? I wouldn't write ISA 37. I would standard on provisions. The standard on provisions defines a provision as a liability of uncertain timing or amount. In my look, I know ISA 37 is provisions. I know that ISA 12 is income tax, but I can tell you there are no marks available for remembering the number of the accounting standard. There are no marks available. I know in the examiner's answer, he sometimes quotes chapter and verse and sub-paragraph this, but that's the examiner's answer. It's not your answer. There are no marks in the marking guide whatsoever for remembering the name of the accounting standard. It's not what this exam is about. So if you don't remember the name of the standard, relax. Just simply say the standard on impairment requires an annual impairment review on goodwill, or the standard on intangible assets prohibits recognition of your own database as an intangible asset. That's good exam technique. That's going to get you the marks. Can we earn a mark if we relate everything back to the conceptual framework? And whether I always hesitate with everything, always. I hesitate to say yes. Is it always the case? We must do this. You are independent professionals. You have to take a judgment. The framework does underpin a lot of things, but you must answer the question that you're being set. That is your task in the exam, to answer the question being set. Okay. Thank you very much. I'm going to call it a day there. We've been going 3 hours or so. I need another cup of tea, and you have been wonderful. And I thank you for your interaction. I wish you luck in the exam. Please connect with me if you want to on LinkedIn. Please certainly have a look at my podcast. Have a look at my podcast. Have a listen to my podcast. Thank you very much indeed. Thank you, Jenny. Oh, so many names going by. Thank you. Thank you, everybody. Sabrina, Michelle, Mohammed. Yeah, I've really enjoyed it. Yeah, thank you very much indeed. And Ryan is coming back to say goodbye, I think.
All right, thank you so much, Tom, for conducting today's sessions, and also for all of our AC students for attendance and also attention throughout the sessions. Hopefully, you have gained more insights in perfecting the art of slaying this paper. So for your information, right, this recording of these sessions will be available within a few days. So do follow our YouTube channel, MY Learning ACCA, and stay tuned for the updates. I will include our channel name in the chat box right now. Okay. We would like to take these opportunities to wish all of our March sessions exam takers all the best, and please continue to stay safe and well during this COVID-19 pandemic. Goodbye, everyone.
Good luck, guys.
Thank you very much
Oh.
for coming, everybody. God
Yeah.
bless. Stay safe. Work
Yeah,
hard, but be kind to yourself as well.
Yeah, all the best to your exams.
Yeah. So we got to think positive, but test negative. Yeah. Yeah, that's wonderful. I mean, I really enjoyed it. Absolutely fantastic. The only thing that would have been better is if I'd actually been in KL or actually been in Singapore, and we could now be going out for a drink and a bit of street food. That would be the only way it's better. But there you go. These things. I've had lots of those great experiences, and we live in a different world now. Thank you, everybody. Yeah, stay safe, Nawinda. Yeah, God bless. Take care.